Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 23rd of January. I'm Daniel Lam, your host for the podcast. What is the biggest investment that average folks would be making in their lives? Well, it could be their kids' education, or it could be their health. But I would say that buying a house would certainly be right up there on the list. In fact, a healthy property market can often trickle through to the stock market. This feel-good effect from solid property prices going into consumption, which makes its way to company earnings, and then good stock market performances follow. To me, the strength in the US housing market, vis-a-vis the Chinese one, is a key reason behind the massive divergence in their relative stock market performance. Recent data suggests that the US housing market is resilient. In fact, the NAHB Housing Market Index, which measures home builder sentiment, jumped from 37 to 44 in the month of January, handily beating expectations at 39. So this came from three areas. First of all, the lower mortgage rates, leading to mortgage application climbing to close to a 6-month high in the week ending the 12th of January. Second reason is the expansion in building permits at 1.9% month-on-month, beating expectations at 70 bips month-on-month and continuing its uptrend. And thirdly, there was a smaller than expected decline in housing start at 4.3% month-on-month compared to consensus pointing to dropping at 8.7% month-on-month. So this housing market's resilience reflects an undersupply of inventory in the US. This undersupply put the floor under construction activity as well as house prices, which are once again rising. So this is in stark contrast to the Chinese property market, which is marred by oversupply, and in turn leading to pressure on prices, and that looped back into a lack of demand. So the strength in the US economy had led to markets decreasing the likelihood of the Fed cutting rates in March, and to a rebound in the US 10-year government bond yield. But in my view, this is actually a good problem to have for the US stock market. Therefore, we continue to have an overweight in US equities, and investors should continue to buy on dips. And the levels to consider would be 45.30 and 43.50 on the S&P 500 index. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.